Hi everybody, Jeff Yasteen here. If you have comments or questions, by the way, write them in the comments section below. Love to hear what you think. And also, of course, follow me on Twitter and on Facebook. You know, it's a lot of fun to brag at a party, about the killing that you're going to make because, you just bought shares of Tesla or some other hot stock. Everybody knows the company. And with Tesla's case, electric vehicles are a hot investment theme these days. But if you were to brag about the killing you're going to make owning shares of a bank or an insurance company, everyone's eyes glaze over. Banks, insurance companies, they're boring. Interest rates, which determine the extent of a bank's profits, are also boring to talk about. The only time people seem to really care about interest rates is when they finance a car or a house. Now, I like to pay cash, but that's another story. I'll go into some other time. But I'm here to tell you, you should care about interest rates and all the rest because I believe that we're all going to make a lot of money from bank and insurance company stocks in coming months and years. A slew of banks, including Citigroup, Wells Fargo, JP Morgan, and a bunch of others, have been reporting earnings this week. And there's also one stock, I'll tell you its name in a moment, that I think is poised to rise 50% over the next year. Now, the actual earnings that these banks report matters less. It's important, but it matters less because it's the positive backdrop of interest rates and the undervalued nature of the stocks themselves that matters most here. So let's take interest rates first. So if we look at this chart of the 10-year Treasury note, the benchmark bond that everyone in the markets watches for clues, it's actually higher now than it was in March at the height of the pandemic panic. Although it's come back down just a little bit in the last few days. Now, back then, you would have paid annual interest of about 0.4%. If you bought the same bond now, it's paying you almost double that amount, around 0.07% or 0.7%. Now, yes, that's still extraordinarily cheap to borrow money, but in this case, it's the direction, the trend of interest rates that counts. It counts because when rates are on the move higher, banks make more money. It's as simple as that. And I think interest rates could move much higher from here. We're only just starting to see the impact of the massive stimulus that we've already seen enacted in the past months. Oil prices are still low at 40 and going to go higher. The economy's obviously running at a slow pace still, and all that will change as the world slowly recovers from the pandemic. And clearly a second Trump administration or a new Biden presidency is going to do everything that it can to continue to rev up the economy and economic growth, and that's all being done with the Federal Reserve's encouragement. Now, back in mid-August, I gave you an insurance company, Aflac, AFL, and I said then that I thought the stock could do well because of the same backdrop and a slow but steady climb of interest rates, which helps insurance companies to earn more money on their premium payments. And that's, of course, the money that we all send in to pay our house policies or car policies and what have you. Now, Aflac is up around 3% or so since then. You can still buy the stock, and if you look carefully, you'll see that its stock chart looks very similar to another financial company I want to tell you about. It's another stock I like, Bank of America, BAC. Now, I'll get into the technical analysis of the stock in a minute, but like most banks, it is unloved by investors, and it's been that way to an ever larger degree ever since roughly 2007 when bank stocks rode the real estate bubble of that time higher and higher until that bubble popped. 13 years later, no one wants to own bank stocks. A good example is just looking at Bank of America's book value. Now, a bank's book value is basically all the money in its vaults, the value of its real estate, the loans on its books, minus whatever debt it owes. Bank of America's book value comes out to around $28 a share. Yet at the start of this week, the week of October 12th, you could buy the stock for about 10% less or a little over $25 a share. So if you ever wanted to own a bank, Bank of America shares are on sale. Now, it's the same way with most of the stocks in the banking sector. Most are hovering at or slightly below their book value. And it just tells you how out of favor they are with investors. Most are more profitable dollar for dollar than they were years ago. Again, taking Bank of America as an example, its net interest income as a percentage of revenue is at 61% compared to just over 40% 5 years ago. In other words, the bank is earning more on the loans it makes with less cost. In a nutshell, I think their book values and therefore their stock prices are set to rise in sort of, stair-step pattern, up a little bit, back a little bit, with the overall trend higher, because the federal government and the Federal Reserve are going to keep priming the pump here. They're going to keep stuffing fuel into the economic engine, if you will, until they get the desired result, which is a revived economy, which we are slowly getting. Now, it's not as if a stock like Bank of America isn't profitable either. Now, this chart shows us what Bank of America's earnings per share looks like on a rolling 12 months basis. Now, each bar represents the bank's profits in the previous 4 quarters of activity. As you can tell, it has dipped somewhat in recent quarters. That is because the Federal Reserve began cutting interest rates basically in early 2019 because it was getting basically signals from the stock market that rates had moved too high temporarily. Then came the pandemic. Yet Wall Street analysts expect earnings to rise from a pandemic low $1.69 a share this year to $2.07 a share next year and $2.72 a share in the year after that. Now let's do just a little bit of technical analysis on Bank of America shares as well. So before I show you Bank of America's chart, actually, I want to show you this ETF. This is the S&P Financial ETF, Select Sector Spider Trust Financial. XLF is the symbol. The important part on this chart, number one, it bottomed, as most banks did in late March. It rallied up here to the 200-day moving average, and then it backed off. Now, what's happened in the last handful of days? It's actually popped up above its 200-day moving average. What does that tell us? It tells us that banks and insurance companies, both of which that make up this ETF, that they're getting stronger. They're getting more support from Wall Street investors. Does that mean that they're not going to go down on occasion or go down for a few weeks? No. But it does mean that investors are starting to feel confident enough that they're buying the banking and financial sector more so than they have in the past few months, because they feel confident enough to bid it up ever so slightly above this 200-day moving average. And one thing I'll say about 200-day moving averages, or really anything regarding chart rating, if enough people believe it, it tends to get reflected on the chart. And you can kind of see that, I'm just pointing this back in October of last year. Again, what happened? The stock moves down, touches the 200-day moving average, and rallies higher. And when it broke through the 200-day moving average to the downside in late February, again, that was a signal that Wall Street was growing much more bearish on the financials as they found their ultimate bottom in late March. The point here, though, is that these banks and insurance companies that make up this ETF are starting to get stronger. So then let's look at Bank of America shares. Now, the reason why I like Bank of America shares has to do with the fundamental backdrop of the company. Frankly, pretty much any decent-sized bank you could buy right now, and the chart's all going to look the same way. And I think they're all going to basically rally roughly the same amount if I'm correct. But I do like Bank of America because it's well supported by Wall Street. Warren Buffett has a big interest in it. It pays a roughly 2.8% dividend, which isn't going to be raised anytime soon because the Federal Reserve wants to make sure that basically all the banks do not overextend themselves in terms of supporting their dividend in a time like now where the big concern is just getting through the economic crisis, if you will. We're not going to have any problem, in my view, with Bank of America or any of the banks in that regard, for all the reasons I've stated earlier. But the point being that this is another stock that's rallied up to its 200-day moving average. It's just below it right now, but let's look on the downside here. We had the stock set a low in March, another higher low in May, another higher low in July, and yet another higher low here just last month in September. That is a sign of rising strength. Now, if we put sort of some trend lines here on this thing, just going to draw these on here for a moment. you get this sort of funnel effect. Sometimes chart readers would call this like a coiling action because it's kind of coiling like a snake. Now again, is all this guaranteed? No. But typically when you see a stock like this coiling inside of this, this funnel, it's usually a good sign. Usually you will see the stock then break through the top of this. And I think that's what we're going to see here in the next month and a half, basically. We are going to see the stock break through the 200-day moving average, much as we saw for the financial ETF. Again, here it is, above the 200-day moving average. So going back to Bank of America, that's what I expect to see here. Are we going to have to endure occasional days like we did on Tuesday, and just overall with the market being a little bit weaker? Yes. That's something when you're buying stocks that are in recovery mode like this one is, that you're going to have to endure. But the way I look at it is it gives you more opportunity to buy the stock. Doesn't mean you have to buy an entire amount all in one session. You can buy a little bit here. You can buy a little bit more a week or 2 weeks later when it's down. That's another key that you want to, another habit you want to build in yourself is actually buying into weakness. Is it going to work every single time? No. There's always risk when we put our money to work in the stock market. If we want to have guarantees, we should be buying certificates of deposit and just be happy with the minuscule interest rate that those things pay. But of course, we're not happy with that. You're not happy with it. Otherwise, you wouldn't be listening to me here. My overall point is Bank of America shares are building strength here. And I believe that the stock is going to be moving higher in the next month and a half as we see the economy begin to build more strength into late fall and through the first part of next year. Now, the other key to think about, though, is what if I'm wrong? How do we know if I'm wrong? The key on that is, number one, if we see Bank of America shares move below a recent low. In this case, that low is around, $22 or so, say 22 and a half. All right, that would be a warning sign, a yellow flag that perhaps these stocks, banking stocks, are breaking down. But you can't read too much into these things. You have to give them some leeway because, you're talking about fear and greed, and sometimes things can get swing wildly in both directions. To wrap all this up, basically into a neat, tidy package, I think Bank of America stock is set to rise 50% in the coming year. If investors think even slightly more positively about the outlook for the economy and for interest rates, basically becoming more optimistic, as we near the back end of the pandemic, they should be willing to pay at least 1.5 times the bank's book value, which is historically still a very low valuation for the bank in order to own the shares. And at that valuation, it would give us a stock price of roughly $42 a share. That's still more than 60% above the current price of the stock.